Hello and welcome to today's lesson. We continue looking at capital allowances. For today, we're going to zero in specifically on wear and tear. But before we do that, we're going to recap on what we had discussed on capital allowances. We had said that capital allowances is an allowable deduction, simply meaning that you're going to deduct it against your taxable income. We said it compensates for two things. That one, in what you'd call in accounting depreciation, we have a standardized charge for wear and tear or for loss in the value of non-current assets that we've used in the course of the year. So that is why we are granting capital allowances. Then the second one is said it is because we need to attract investment both locally and internationally, and that falls under our fiscal policies. So as a result of that, we grant capital allowances as an incentive to bring in investments in the country. We also said that there are different categories of capital allowances. We said there is investment deduction, there is industrial building deduction or allowance, there is wear and tear, there is diminution, and there is going to be mining allowances and shipping investment deductions. So we're going to look at all those deductions one by one. So for today, we start with wear and tear allowance. So our topic again, capital allowances. Our subtopic, wear and tear deduction or allowance. So you can have either as deduction or as allowance. Now you remember I had said that for you to grant capital allowance or for you to be able to deduct it against your taxable income, you must have owned the assets, you must have used those assets in the course of the year in generating taxable income. That means you must have used them for business purposes. So those conditions will still be existing. That for us to deduct wear and tear, we're going to deduct it on assets that are owned by the business person or by the taxpayer. We're going to call that qualifying assets. Then those assets must have been utilized in the course of the year of income, and they must have been utilized to generate the taxable income. So those three conditions will apply for each of the capital allowances that you're going to be looking at. Now, for wear and tear purposes, we are going to define this as a deduction in recognition of the loss in the value of machinery that has been used in the business. So, allowable deduction with respect to loss due to usage, loss in the value of machinery due to usage in the business. Okay, so you're going to define what machinery is. So contrary to popular usage of the word machinery, the English meaning of that word, for tax purposes, we're going to take a wear and tear machinery to be any non-self-propelling machinery or any self-propelling machinery that is used other than machinery that is going to be used in the production process. So any other machinery other than what you're using in the production process. And here by production process, we mean the input-output conversion cycle, where you take raw materials from your suppliers, you convert them into finished goods, and then you supply the goods to your customers. So any machinery that is not used in the conversion process, what you're going to later call processing machinery, will be machinery for wear and tear purposes. Like you're going to see later, processing machinery will qualify for a different class of capital allowances. So for wear and tear purposes, we're going to take machinery, and then depending on the nature of the machinery, we're going to put it in a specific class. So we are going to pull assets or qualifying assets are pulled into 4 classes. Then wear and tear, we abbreviate wear and tear as W&T, is granted at a specified percentage. This percentage is specified by the commissioner on reducing balance basis. We said earlier that in our earlier lesson that reducing balance basis gives you the accounting equivalent of net book value, which we said is called WDV, or written down value. Right. So we now want to group the machinery into the pools. Now remember, these pools are provided by the commissioner. So you cannot edit the pool, because like we had said earlier, that capital allowances is governed by the Income Tax Act, the second schedule of the Act. So we are still going along with that, the part of the Act. So the Act has pulled machinery into 4 classes. So these classes are abbreviated as Class 1, 2, 3, and 4. So we want to know what falls under Class 1, Roman capital 1, 2, 3, and 4. So we start with Class 1. So Class 1, at a percentage of 37.5% of the qualifying cost. We're going to explain what qualifying cost is. We're going to abbreviate qualifying cost as QC. This is a class for heavy earth moving machinery and heavy self-propelled machinery. Very important. Heavy earth moving and heavy self-propelled machinery or self-propelling machinery. That simply means that the qualifying machinery must be capable of moving by itself. So it has an engine. So example is an airbus, train, a normal bus, tractor, trucks. So those are just examples. So heavy earth moving, heavy self-propelled machinery. You'll take the qualifying cost. Qualifying cost, we're going to define the historical cost of that asset plus any incidental cost of acquisition, and you grant that at 37.5%. Then Class 2, this is for office machinery. So any kind of machinery that you'd normally find in an office, it will fall under Class 2. And this, the rate is 30% of the qualifying cost. So for example, computers and the peripheral devices, photocopiers, calculators, office calculators, and other items that you find in the office. So that goes to class 2. Then you have class 3. This is for light, self-propelled machinery. Again, that word, self-propelled, meaning that it has an engine, and the rate is 25% of the qualifying cost. So, for example, saloon vehicles, saloon cars, vans, lorries with load capacity of less than 3 tons, motorcycles, and such like. So here it's light and self-propelled, what you'd call a small vehicle in Kenya. Now, this saloon cars, we're going to see much later how we treat it for the purpose of class 3 or inclusion in class 3. Then class 4, this is for other machinery, not included in class 1 to 3. This machinery must be non-self-propelled. That is, except a ship. And the rate is 12.5% of the qualifying cost. So these are the various classes. So what you'll normally do is that you'll be given a list of assets that are owned by a company or by a business, and then depending on the nature of the asset, you're going to put it in pool 1, pool 2, pool 3, or pool 4. So again, in pool 1, class 1, what you're calling class 1, for an asset to qualify for here, it's got to be heavy earth-moving or heavy self-propelling machinery. Then for class 2, it's got to be an office machinery. For class 3, it is a light self-propelled machinery. So again, it has an engine, only that it's not heavy like what we have in class 1. Now, something worth noting is the lorry in class 3, lorry of load capacity of less than 3 tons. So when the load capacity here is more than 3 tons, lorries of load capacity of more than 3 tons, it goes to class 1. So you look at what is the load capacity. How much is it able to carry? Then class 4, any other machinery that will not fit in class 1, 2, or 3 goes to class 4, so long as it is non-self-propelling, meaning that it can't move by itself. So for example, here in class 4, we'll have things like carpets, what we would not ordinarily call machinery. We'll have furniture and fittings. Then we will have anything else that is not non-self-propelling, but it is found in the office. So we will have something like CCTV cameras, we'll have televisions, we'll have freezers, we'll have refrigerators, we'll have billboards, and we'll have neon signs. Now, the reason for the inclusion of billboards and neon signs is because if you're doing a billboard, it is a marketing, it's going to help us to market our products, reach out to the customer. So it's going to help us in what we read in the earlier lesson, that it's going to help us to generate income from the business. So it becomes an expense that is wholly and exclusively incurred in generating income. Now, if you look at these, class 1, 2, 3, 4, all these are non-current assets, meaning that the cost that we've incurred in buying them is what we would call capital expenditure. Now, back to something that had been covered earlier, Section 15, allowable deductions, Section 16 of the Act, disallowable deductions. Capital allowances are disallowable, meaning that you're not allowed to deduct them as an expense that has been wholly and exclusively incurred in generating the taxable income. And the reason is that by definition, capital expenditure being incurred on a non-current asset implies that you will derive benefits from the asset over a long period of time, and therefore you will spread out the cost or the loss in the value of that asset over the expected lifespan of the asset. So that is why we are now disregarding depreciation and then considering what we said is a standardized wear and tear for each of the items that will be applied for every other person or every other taxpayer. Now we're going to look at a wear and tear schedule or schedule, which is going to give us how do we now actualize these poles. So we do that in a schedule. So we'll have wear and tear schedule for year ending. So we have our 4 poles. So we'll have that divide into 4. 1, 2, 3, and 4. So in the first one, we'll have class 1, class 2. This is the format that we'll be using in computing wear and tear, class 3 and class 4. We put the rates 37.5%, 30%, 25%, and 12.5%. Then we put the currency. We're dealing with shillings. So shillings all through. Now, we realize that, so we put the year 2017. So we'll have 1st January 2017, written down value, brought down. Remember we said written down value is the cost of the assets that you had bought in the previous years. You have claimed wear and tear on it, but there is still some residue that is remaining. So this is the residue. So we'll have brought down, and then additions, what you have bought in the course of the year. So we're going to add 1 item per class. So here we'll add a bus, that is class 1. Then computers goes to class 2. We're using the schedule there. Then we have saloon car, light self-propelled, goes to class 3. And then we will have furniture and fittings. That goes to class 4. Then we dispose, less disposals. So from class 1, we will dispose a tractor. Class 2, we dispose a photocopier. Class 3, we dispose a motorcycle. And class 4, we are going to dispose a carpet. Office carpet. This is office carpet. So dispose that from class 4. Now, what we want to arrive at is what we would call in accounting net book value. So you remember, in accounting, you normally have cost less depreciation. That gives you the net book value. And what we called the equivalent is the written down value. So you're saying in the previous years, we had bought things. They fell in class 1, 2, 3, 4. The residue of what you are yet to claim, that is what you've brought down. So that is why we have items here that are not here. Meaning that tractor is part of what we have here. Photocopier is part of the residue that we have at the beginning of the year. Motorcycle, the same case, and office carpet is part of the residue that we have in class 4. So we have our written down value brought down at the beginning, balances at the beginning of the year. We have added what we've acquired in the course of the year. We have disposed what we've sold off in the course of the year. So what we have now is what we are calling qualifying cost. It is qualifying for wear and tear. So we have our figures in each class. Then we now less the wear and tear. Less wear and tear allowance. So wear and tear allowance is going to be X percentage of the qualifying cost. Look at this. This is 12.5% of the qualifying cost, 25% of the qualifying cost, 37.5% of the qualifying cost, and 30% of the qualifying cost. So our qualifying cost is this amount. We'll see in our real illustration. So we will take this amount, multiply by 37.5%, that times 30%, that times 25%, that times 12.5%. So we'll get our wear and tear, what you're claiming for the current year. And then now we will have the balance carried down, which is equal to what we will bring down. So we have 1st January 2018 written down value brought down. Then the schedule continues. For 2018, we have written down value brought down. It's equivalent to what we had in 2017. So we'll add the additions in the respective classes. We dispose from the respective classes, and then we grant wear and tear. Now you realize that since we're doing this for the year of income, year ending, year of income, we're going to have this and claim it every year. So it means for 2017, for example, using this illustration, we will have capital allowances or wear and tear allowance, classified as class 1, class 2, 3, and 4. For each of the class, we have an amount, and an amount. So this becomes our total wear and tear. We're going to discuss the format so that we know what to place what. So we'll look at what is written down value brought down, what is addition, what qualifies for disposal.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.